What are banks really? In a virtual credit environment or virtual money environment that we have already, they're nothing more than glorified bookkeepers.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Hi there, my name is Shane Moran, and I am back in the vault again this week. We have a great episode. Welcome to the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects of the global economy in these historic times that we're living in right now. Hey, we have exclusive access to experts and insiders. We reveal information and insights that you simply won't find anywhere else. And now this week, we have the one and only Andrew Maguire, precious metals expert and whistleblower in the vault. And to help him pull back the curtain, he'll be joined shortly for his first time on Live from the Vault, industry expert Jeff Snider, co-host of the Eurodollar University podcast. We'll put a link down there below. That's right. Jeff Snider is in the vault, and you're not going to want to miss this conversation. And just before we get started here, please help spread the word about this channel by hit that like button if you haven't already done so. Share this information and also subscribe if you haven't done that either. And if you want to be notified in real time as each episode goes live, just click on that black bell right there. And let me tell you a little bit about Jeff Snider if you haven't already met him. He's the co-host of the Eurodollar University podcast, and he's also the chief strategist for Atlas Financial and advisor to Portfolio Shield. So Jeff is one of the foremost experts in the global monetary system, specifically the Eurodollar reserve currency system. And it's, as he says, it's grossly misunderstood intricacies and the inner workings of the particular repo securities lending markets. And so with that, let's head over to the UK and talking gold with the one and only Andrew Maguire and our special guest, Jeff Snider. Over to you, Andy.
Thanks, Shane, for the introduction and telling us a little bit about Jeff. Hi, Jeff, and thank you so much for joining us today. And it's nice to go a little off piste because we tend to be so siloed with our gold and silver markets, and yet what you're going to bring to the table today is so important because we're looking at the bigger picture and what really all the crosses that drive pretty much everything. So let's all hope everyone sits back and takes this all in.
Yeah, thanks for having me, Andy. It's amazing, right? The monetary system actually affects everything. Who would have thought?
Well, Jeff, you are, I think, and I've done some work and looked at your stuff, and I guess if we were to say anything, monetary mechanics is pretty much is rather a big specialty of yours, and I think it caught my attention when you said that central banks are not in control of the levers of money, and that the global monetary system is controlled by an opaque and unregulated Eurodollar exchange market. I mean, we're talking about something that was back in the 50s or something. Look, can you kind of walk our subscribers through this, please, and perhaps start with, I mean, if it's possible to even define, what is the Eurodollar?
Well, technically speaking, the Eurodollar started out as nothing more than US dollars on deposit outside the United States. The term euro doesn't necessarily refer to Europe, though that's where this, what used to be called a continental dollar, developed. There's lots of dollars running around Europe, and confluence of events, it started out as sort of its own exchange mechanism for a variety of reasons. And then it took on a life of its own during, what Robert Triffin called what came to be called Triffin's paradox or Triffin's dilemma. The Bretton Woods standard was not meeting the needs of a globalizing economy. And lo and behold, there's this offshore US dollar market out there that once we've stepped away from the technical term or the technical use of US dollars on deposits outside the United States and started just trading bank liabilities, then the system became elastic enough and expansive enough and became more more able to not just take on the roles of a reserve currency, but do so in a way that was flexible and dynamic to meet the changing needs of a global world. So what we really have is, so we started out with these US dollars on deposit outside the United States, but then a Eurodollar essentially became a claim on US dollars. And then the claims on US dollars became the dollars themselves. And when the claims on US dollars became the dollars themselves, this ledger form of money, that's when it really opened the door to all sorts of experimentation and innovation, banks coming up with different ways to exchange settlement practices. And that's where money took a real left turn there into some real weird and esoteric formats, which made it very difficult for authorities and for regulators to really keep track of what the banking system was out there actually doing as far as money. And eventually regulators said, we just can't. We can't keep up and keep track with all this monetary innovation. So we're going to start focusing on moving an interest rate around and calling that monetary policy. And we'll let the banking system out there and the rest of the world figure out the details, these esoteric forms of monetary transactions, or what is it Alan Greenspan called the proliferation of financial products. We'll let the banks handle the details, and we'll just try to influence behavior by moving interest rates around. And we'll see if that works. And for a very long time, it appeared to. And for a very long time, people thought that the Federal Reserve was this magical institution that moving the interest rate up and down, the federal funds rate too, not even that important an interest rate, the federal funds rate will move it up and down. And if everything works out fine, GDP is growing, inflation is relatively low, we'll just assume the Fed did it. It must be this interest rate targeting stuff, when the real magic was over here in the banking system that was doing all sorts of things that nobody was really paying attention to, though we did get glimpses of it through history. I mean, LTCM was a warning, a huge warning. But essentially the banking system did all this money stuff. And eventually we get to 2007 and suddenly it breaks down and nobody knows what to do at that point. So that's when you really start to realize, oh, maybe the central banks aren't really central banks because we have a crisis and they're not actually lenders of last resort in monetary formats that they don't really understand all that well.
Interesting. And so I guess what you're saying is, and obviously I met with Andrew Bailey, who is the current governor of the Bank of England. I met with when he was head of the FCA, and I was looking at the OCC report, and I was looking at what had happened in 2008, and I was looking at all of this stuff that can be rolled over infinitely in a 14-day, anything under 14 days can infinitely rolled. But ultimately, that threatened the too big to fail banks. So we sat down with my member of parliament, and it was even read in parliament, and we said, and I asked him, well, what's going on? And he said, well, what should I look at? And I said, well, explained in detail. I won't bore with the detail right now, but we're talking about these flows, where are they going? Are you aware of them? What's going on? And he said, well, sorry, but it's unregulated. So what I'm hearing from you now all adds up. So basically, if I'm correct, the offshore Eurodollar is not regulated or tracked like it could be if it was, say, for example, on the trustless blockchain rail. So basically, it sounds like the data relies on trust inside the system. It seems a bit hokey to me. Is this sort of it almost honor amongst bankers? I mean, that seems like an odd situation.
It is an odd situation, but it does make sense in the context of the development. And it moved away from trust toward collateral, which is why collateral is so important. But yeah, it started out in the early days based entirely upon reputation. In fact, if you remember, Herstat failed in the 1970s. BIS regulators and international regulators said, well, how do we regulate this offshore system? And the early warning and regulatory scheme that they came up with, they never got implemented because it was kind of, as you're saying, hokey. Was let's set up a system of gossip. Let's incentivize bankers operating this offshore unregulated space. Let's incentivize them to tattletale on their counterparts, because that's really the only way to understand what's going on. Because it really is in the early days anyway, it's really a closed space. As you said, honor among bankers, reputation meant everything. But there was a huge problem with that, And the problem with that is it doesn't go beyond the small clique of bankers, right? You can't have a good relationship with everybody. So in order to mass produce money in this unregulated space, we had to have some way of becoming not quite trustless, but at least standardized so that we can transact in huge volumes and feel comfortable doing so, even if we don't know the counterparty on the other side of it. And that was standardization of collateral, financial collateral, not using real economy projects, not really using what used to be called real bills, but instead government bonds. Oh, geez. So government bonds became sort of the standard financial collateral that allowed a lot of this mass production of money to take place, because you're assuming, I don't know you, Andy, you don't know me, but if you give me a treasury bond or a UK government bond, then we can transact and feel comfortable doing so, because I now have the rights to take your collateral. And then if you default on the loan, no big deal. I've got a market that I can sell the collateral into and we're all fine. So it placed an enormous amount of emphasis on financial collateral in addition to reputation, and all of it taking place outside the regulatory framework. As you said, none of this is tracked. None of this is monitored. Even to this day, we have absolutely no idea how big the Eurodollar system is. I mean, we can kind of guess at it, but there's no statistics that track it. There's no regulatory body that says we do this and we know exactly what this number is. It's just a big open black box. And only very recently have even regulatory bodies, as well as economists even, taken more of an interest in it. It wasn't that long ago you used the term Eurodollar and people look at you like, what is that? I've never even heard of it before. So we've got all of this massive amounts of money creation that take place. Collateral is a huge part of it. Nobody really understands how it all works together, and including the participants in that system. I can't tell you how many times people come up to me and say, I used to do this for a bank and I had no idea what I was actually doing. And now it kind of makes sense. So it's this big intellectual gap that we have. And as we started out this conversation, it's kind of an important topic, right? We're talking about the global monetary system, the global reserve currency. And it's just out there doing things or not doing things, and really hardly anyone is even aware of it, and fewer still really have any good handle about what's really going on there.
So it's interesting. So, for example, in my simple world here, we don't need 10 sheets of legalese when we do a deal in the wholesale markets. You set your price is your price. It's done, and it moves, and there's no issues. And so it is in other words, what used to be, when I imagine the old banker with his bowler hat and his stick and his pinstripe suit, that was how it worked. It worked by word. You didn't need all these lawyers. And so now I'm a bit fascinated because I guess my question is, how is the liquidity created? And obviously in this unregulated world, how is it created?
Well, liquidity is, first of all, it's a fungible term, but then again, everything about the Eurodollar system is fungible, which is why we get into this practice. Like you said, why do we have so many layers of lawyers and legalese? Because being such a fungible, essentially blank space, really a blank canvas for banks to experiment with, you can understand why it gets complicated real soon. Just like we were just saying here, a simple transaction, a repo transaction, which is, a collateralized loan. You have cash, I have collateral. I want to borrow your cash. I post the collateral. It sounds really simple, but in practice, it's gotten to be absurdly complicated. And if not even really just absurd, because the collateral I may be giving you is probably not mine. I've borrowed it from somebody else who borrowed it from somebody else who borrowed it from somebody else. So even what's supposed to be a simple, straightforward collateralized arrangement, which is absolutely vital to liquidity, because if you have a collateralized system, collateral is as much as important as cash is, and money doesn't circulate without collateral, and we've got collateral that's repledged, reused, and rehypothecated. And what is liquidity? Liquidity is both collateral as much as cash. And what that really means is that there needs to be these dealer banks that stand in the middle of all of these transactions, pocketing a spread in order to make sure that collateral matches cash and cash matches collateral and derivative transactions take place. It's really about the balance sheet constraints of dealers who stir the pot through this unregulated system and make sure that money continues to go where it needs to go, and credit can get created, and liquidity can be actual liquid. And without the dealer banks, when they become balance sheet constrained, the whole thing really starts to slow down. Collateral becomes harder to source. Cash becomes harder to match with collateral. It leads to all of these hidden problems that if nobody's really, when nobody's really paying attention to it, it's just as if the music kind of starts to slow down. And then in 2008, it stopped. At various times along the way, the music slows down, and we're not really sure what's going to happen, and not really sure why the music is slowing down. But it's really without the dealer banks policing and regulating the wholesale markets and making sure all these things circulate, that's really where global liquidity in the monetary system comes from.
And so, there's various estimates out there. Some of them are empirical, but some of them look fairly likely. But and I even had this discussion with Andrew Bailey, and he didn't bulk at it. There's probably about 2 quadrillion of derivatives, just derivatives out there. Who knows? Anyway, what number you want to have? 1 trillion, 2 quadrillion? These numbers are actually impossible for me to actually conceive because it's just so big. Now, what happens? What happens now? I guess the question is, so much going on at the moment. We have, I know many people thought that not much happened with the BRICS meetings last week, but other currencies other than the dollar are kind of evolve. Commodity currencies that will be bilaterally settled amongst other entities, whether it's gold-backed or whether it's SDR type of baskets or whatever it might be. But down the road, this is all coming. So if that's the case, and there is a form of de-dollarizing, how's that going to affect the Eurodollar system?
Well, the Eurodollar system is essentially, that's what it's made for, it's about circulating money as a reserve currency needs. A reserve currency needs to be in as many places and as easily accessible as possible, because that's what a reserve currency is, really a medium between various different systems. So the Eurodollar lived its life, and it did really well. Let's face it, for all its major faults, during that period, especially the globalization period from the post-war era up until 2007, we saw a period of unparalleled prosperity around the world. So it did a great job while it was working. Toward the end there, it got way off the rails, but circulation of money and credit through the rest of the world, that part worked out really well. The question is, why is it still there if it broke down 16 years ago? And the answer is, as you're talking about, Andy, is there really isn't a competing reserve currency arrangement that is ready to go, that it's a viable alternative at this moment in time. And it takes quite a lot of time for another competing currency system to develop, whether it's an ad hoc or top-down process, doesn't really matter. You can't just slap one together overnight. So the Eurodollar system is always going to be operating in the background, and de-dollarization isn't necessarily, let's get rid of the dollar because we hate the U.S. government. It's really, this system doesn't work for us anymore. It doesn't work for anyone really anymore, but it's the only one we have. And so, number one, there's a tremendous amount of incentive among those inside the system to keep it going, especially the global banking cartel, because they've been privileged by it for a very long time. So they have political power. They have, there's institutional inertia. There's very little urgency to do anything, which means de-dollarization is really about how do we replace the Eurodollar very slowly, incrementally over time. Can we develop a competing currency system that does everything that the Eurodollar actually does, and maybe do it a little bit better and a little bit more stable? And that's a longer term project that, as you know, some countries out there are experimenting with different bilateral arrangements. The BRICS thing, I don't put a whole lot of faith into that because, you're not going to have a BRICS relationship with India and China at the top of it who are constantly at each other. That just goes to show you how difficult it is to put together a competing, useful reserve currency system. It's an incredibly tall challenge. So looking ahead, there's all sorts of competing ideas, but they're a long way off because it's a very tall task to replicate the good parts of the Eurodollar system and try to do at least as well as it did, as well as it does even now in the future. It's just a huge, huge undertaking.
I was looking the other day, and I just want to comment on this, whether it's got anything to do with it or not. But I was looking at the Swift RMB tracker, and what it shows is there is no currency that has lost more ground in global trade than the euro. And I think in just over 2 years, the euro has fallen to 39.5% of global payments outside the eurozone to just 13.6%. The pound 5.6%, the yen 5%. How does all this stuff fit in? I'm really still trying to get my head around it.
Well, if you look at it from the FX perspective, especially currency swaps and derivatives, all these other currencies are simply the other side of a dollar transaction. And so what that has said is, and you're right, that you see it in the FX side too, the euro has fallen relative to other currencies. And the BIS calls it other currencies, which is usually China's yuan. They have gained at the expense of the euro. I think a lot of it just has to do with the fact that the global economy and the global financial system too has reoriented itself toward Asia. And so there is a trend to use more local currencies in Asia on the other side still of the US dollar. The US dollar is still the intermediate currency, but that's what we're seeing is what is actually on the other side of these US dollar transactions. And you see more of the global south, but in particular the Asian currencies and less of Europe, for a variety of reasons, not in addition to convenience. It's, that's where the global economic and merchandise center has really transformed. And as the Asian economies become much bigger part of the global economic picture, they're exerting their own influence as you would expect them to. And it's not unreasonable for them to try to transact in their more familiar terms and their more familiar currencies, even if they still have to intermediate through US dollar and the Eurodollar system to do so. So it's really just this migration toward Asia. That's another long-term process too.
So when we see, for example, after non-farm payrolls, for example, last week, we see Mester coming out and saying, we're going to raise rates. So really what we're saying here is they're flying in the dark. They have no clue of what they're doing whatsoever. It's interesting because what they're up against is, so really, I suddenly think, okay, so you're talking about increasing rates as if you have any power to do so. And I'm learning a lot from you here because, always give them more credibility than they should have. But essentially, if that's the case, then you had Fitch and Moody's coming out ahead of that, kind of suggesting, look, if you raise rates any more-ish, then you're going to drive liquidity out of the banking system as depositors chase the sugar high of a 5.56% rate that they can get, sucking liquidity out of the system. Then you look at the regional banking system. Then you look at the CRE sector, and you think, my God, if that CRE sector, which looks so vulnerable, if that actually does lack any more liquidity, surely that is going to, what will the Fed do? How will the Fed react to if they raise rates and it has triggered these Fitch downgrades? What on earth? What are they going to do?
It's funny, Andy, because, that's the one thing they never talk about, right? Is they never use the word money. As you were just saying, Mester's talking about the payroll report and the CPI. That's not what a central bank is supposed to do. The central bank is supposed to say inflation is money. And if we have inflation, there's likely too many money. So we need to constrict the money supply. They never talk. They don't even use the word money anymore because they don't know how. They don't know where the monetary system is. And so they're looking at macroeconomic variables and saying, well, we don't know what's going on in the middle of the monetary system, but we assume that if GDP is relatively stable and the consumer price index is relatively stable, then what we're doing is working. And if the economic variables are not conforming to our ideas of what the economy should be, then we're assuming that we need to do something to influence the monetary system. That's number one. Central banks are detached from the monetary system and looking at it backwards through backwards looking macroeconomic data in lieu of being able to look at the money supply or money circulation, really liquidity, and say it's sufficient or it's insufficient. So number one, the Federal Reserve, the ECB, all these central banks are already flying blind, detached from the system, which means their really only variable is interest rates. And interest rates, despite what most people believe, the Fed does not control interest rates. They don't even control short-term money rates. They have their own benchmarks, which are able to heavily influence the short end of each yield curve. Because if the Federal Reserve is going to offer, say, 5% in IOER, then banks are going to say, well, I can get 5% from the Fed, or I can get something similar in Treasury bills or some other short-term liability. So the short-term market rates are going to be about where the Federal Reserve wants them to be. But you go much further out in time, and already rates act independently, as we see with the inverted yield curve. And that independence in the yield curve means a whole bunch of things, including what you were talking about before. So we have money that gets cash that was migrated out of the banking system to a lot of non-banks, money market funds primarily, who are benefiting from this increased short-term interest rate environment. But even that was not supposed to trigger a banking crisis, because that's what the Eurodollar system is. The Eurodollar system is a wholesale money market network where if money flows to money market funds, for example, then banks should have been able to borrow those funds back from the money market funds, assuming they had the collateral to do so. So something interrupted the recirculation of cash, even if it was disruptive in terms of migrating to the money market funds to begin with. So what the Federal Reserve does is what it always does in response to those things. First of all, they never see it coming. They never get out ahead of these things and say, oh, we see a problem here where money market funds are taking lots of cash. We're going to be prepared for eventual downside. We're going to create some new program to cushion the blow. No, something always happens, like the crisis in March. And what do? They cobble together some brand new tool, slap a 4-letter label on it, and say, this fixed the situation. Hopefully everybody will forget about it, and we can all go back to just pretending everything is fine. That's really what monetary policy has become. And the official term for it is the Fed is no longer lender of last resort. They call themselves market of last resort. Or I guess in the case of the BTFP, they're the bank of last resort or something like that. So if the crisis continues to develop, and I think I agree with you, Andy. You look at commercial real estate and the exposures to it. There's no way that this ends with a soft landing and everybody's happy. What happens is I think the Fed comes out with another tool and says, we're going to start buying illiquid commercial CMBS or some other kind of thing. They're going to act on this market of last resort type of behavior, and maybe it'll work, maybe it won't. The one thing to consider is that they don't act until the situation gets to be a big problem anyway. So the system's already in major issue, and then they come in and say, we've got this new tool, and maybe we hope that that's enough to calm the crisis. That's a whole lot of bad bets from an agency that doesn't even realize what's going on to begin with.
Interesting. So obviously now, the Fed, we all believed until a minute ago, that they had some sort of influence. But I mean, obviously, so having raised rates in record amount of time, I guess this is one more example of knowing they don't know what the hell they're doing, having raised rates so quickly, so fast, and having surely one eye on the regional banking sector and duration issues and one thing and another. So having done that, should they not have at least stress tested these banks before it caused that kind of bloody issue?
Well, they do. They stress test everything. But, how good are their economic and econometric models? That's just the question. Their econometric models have proven time and again to be, cartoonish, childish, too overly simplified, and too often just too favorable to optimistic outcomes. There's definitely bias in all their econometric models. So I don't think they have good information. In fact, I know they don't have good information. You read through any amount of transcripts, either 2008 or afterward, it is clear that their models get it wrong time and time again. They think one thing's going to happen and another thing entirely happens. They're never prepared for liquidity problems because, as we just talked about, they don't monitor the monetary system. They monitor macroeconomic variables and make a whole bunch of assumptions about what might be going on in the monetary system from it. So, their stress tests reflect that lack of knowledge and lack of capability. Their stress tests are like DSGE models. They're just overly simplified and biased. And so I'm sure they stress tested the hell out of every part of the economic and banking system before they started hiking rates. What is it, the teal book or one of the colored books, the green book that they have that puts together, it's a whole bunch of simulations on all of these permutations and variables. And I'm sure they did. I'm sure they thought, well, under an extreme scenario, this might happen, and it's no big deal. It's completely within the bounds of our capabilities. And then something completely unanticipated happened, and they have to go back to the drawing board and do a bunch of other models and everything else. So they are absolutely flying blind. It's because they're missing the one part of it that actually matters the most. And you would think it's the one part that they would be focused on, laser focused on. It's the Federal Reserve. Don't they do money? And the answer is no, they don't. They do all of this other stuff to make it look like they do money at the Fed, but they really don't. And it's really because they don't, they have to keep up this pretense that they do, because once you see behind the curtain and understand the Fed is what they're actually doing, it's a very different worldview.
And this is, again, raises the question, is like, so I guess maybe we shouldn't apply any logic or thought to this, but the thing is, you mentioned behind the curtain. Who the hell is behind the curtain?
That's the big banks. I mean, that's one of the things I like. Because I talk about the Eurodollar system a lot, people think I'm selling you the Eurodollar system. I'm not, because I look at the Eurodollar system as, okay, it was good for a while, but that's not how I would do it. We have a cabal, a cartel of the largest banks in the world who are really in charge of not just liquidity, but money creation and intermediation, all of these crucial, vital functions to the global economy. And they're in the hands of this banking system. And it's almost like a mafia organization. I don't mean they're criminal. I mean, a mafia organization, they have all of the stuff they're doing in the background, and they put the Federal Reserve as the figurehead to take all the hits in public, right? So Jay Powell gets on TV whenever there's something wrong, and everybody says, oh, Jay Powell, you did something wrong. Meanwhile, it's the banking system over here that nobody's paying attention to, and everybody kind of has a sense that, I don't know what's going on Wall Street, but it seems like that's where the real power and political center is, and the Federal Reserve is just the public face of it. So the power behind the curtain, so to speak, is in this banking system that hasn't really worked and functioned very well for 16 years. But because nobody really takes a look at it, nobody's saying, well, maybe that's the part we should be looking at. Maybe that's what we should be really thinking about, instead of what is the Federal Reserve going to do with its rate hike policies. Let's look at the banks and what they actually do as far as money and credit and liquidity and intermediation. And maybe we could do this a lot better.
And that brings us on to the Bank of International Settlements, because that's the next logical. I mean, when you think about it, then the bi-monthly meetings there involve all of the top bankers, the central bankers, top bankers. So, and there's no records kept, and without going into conspiracy theory, on the top floor of that, there is 10 or 12 people meet, and so surely. They must be aware of the knowledge you're talking about. You're talking about the Eurodollar system. You're talking about how it interacts with everything else. If anyone's behind the curtain, it has to be there. And it's so interesting because they also, of course, we track it very much from the gold market perspective. But any thoughts on that?
Yeah, I don't think there's this, you have this vision of a bunch of the best and brightest people sitting in a room, pushing buttons and creating using their levers of power to directly influence all of the things that they want to influence. I think it's more of, we have competing interests in this global cartel, and there isn't a whole lot of systemic awareness, and there's not a whole lot of systemic influence, or even just how it all fits together. Everybody's kind of doing their own thing. And while the system, everybody was taking risk and the entire system was expanding, that was fine. There didn't need to be a centralized lever of control or a centralized policy-making body. But since it started to break down, I think there's actually even less awareness of the systemic factors, because everybody has kind of turned inward. And it's like, okay, how do I protect myself from becoming Lehman Brothers? So I'm going to look at my own balance sheet and the hell with everybody else. And that's kind of made the situation worse, because now there's even less of a systemic presence across the entire system. So I think they get together and I think they talk about the general outcomes and the general lack of outcomes across the system, but I don't think they talk about how to fix it. They're just, hey, you know what? I did this stuff on my own balance sheet to protect myself. What the hell are you doing? Because I don't think it's working here either. I think there's really a lack of overview of how everything fits together, which kind of makes sense. Again, going back to my conversation with a lot of bankers, they don't really know what they're doing either. They have very tunnel vision, very narrow focus on specific mandates without really figuring out how that fits in the wider system. And again, it's true of governments and regulators too, are just now starting to think about shadow money and shadow banking. I think there's from the top layers, there's not a whole lot of awareness, and and the further down in the organizations you go, it becomes much more specifically tied to individual mandates. So it's all just kind of working by accident. There's no central organization that really puts everything together. I know the BIS is trying to get it behind the curtain. Among more of the official institutions, they're the one who regularly puts out scholarship about what's going on in derivatives and how does that impact global financial flows and things like that. But even that, you can tell they're kind of brand new to all of this, and they don't really have a whole lot of situational or overview awareness.
Yeah, it's interesting because, I mean, there's just that organization alone, before we leave it alone. I mean, during the Second World War, I mean, you had finance ministers of Germany. Well, I mean, this is while the war's going on, while people are killing each other, drinking brandy together and talking about stuff, So it's interesting, I guess maybe that kind of underlines what you're saying too. Really, it kind of does.
I think, you know what it is? It's, hey, this thing worked for a long time and we didn't need to babysit it. For decades and decades, we piled up prosperity. Everybody was happy. We got, it looked like close cooperation, even from nominal enemies. We worked together with China for a very long time, and nobody really needed to know any of the details. And so everybody thought, like you said, let's just have a couple cocktails. We'll talk about some big picture stuff and we'll just let it all work because it seems to work. And I think there's almost institutional hope that just by random accident, something finally clicks and it goes back to the way it used to. Maybe some central bank hits upon something. Maybe some banks get together and they do whatever it is. They felt they didn't need to babysit the system, and so they got as much detached from it as did policymakers and regulators. And now they don't really know what to do. They don't know how to go back in and how do we define and monitor and put everything in nice, neat little boxes so that we can analyze it and really take it apart from a systemic perspective. I think it's just, hey, the world hasn't fallen apart. Let's just keep going another quarter, another couple months and see what happens. It's really just, you get a very short-term viewpoint because you don't know what else to do. So let's just hope it kind of just works itself out.
Did the LIBOR scandal, did that lift the lid a little bit off what we're talking about here?
Yeah, and I think it did in the opposite direction, though. What I mean by that is the LIBOR scandal was the government, not the bankers.
Okay.
Because, yes, from what we understand, there was, I don't know if I would even call it cheating. Bankers were simply asked, what would you borrow at if you were going to borrow in the market? That's an opinion. But yes, that's how the Eurodollar system benchmark worked. The bigger scandal to me was that regulators took a hard look at LIBOR because LIBOR was exposing exactly what we're talking about. It's a offshore global dollar money rate. We don't want people talking about that because if they do, they'll be, wait a minute. What do you mean the dollar isn't the Fed? What do you mean the dollar isn't the U.S. Treasury? We don't want people knowing that there's this Eurodollar system out there. We need to get rid of this LIBOR rate because, number one, not only is it the Eurodollar rate, number two, it actually exposed how badly central bankers performed during the crisis in 2008, 2009, as well as again in 2011. You had LIBOR and the TED spread shooting up when the Fed said, we printed a bunch of money. We did a bunch of QEs. We did liquidity. And here's LIBOR saying, this isn't liquidity. This isn't working. So suddenly in 2012, the bankers get in front of Congress and say, the central bankers get in front of Congress and call it the crime of the century? Wait a minute. That's not the case. So I think the LIBOR scandal is how they took a decade-long crusade to get rid of it, to bury it, to go back to essentially bury what was useful information about how the monetary system works so that we can go back to pretending the Fed is in charge. Now we have the SOFR rate, which is ridiculous. It's not an alternative to LIBOR to begin with. So to me, that's the real scandal, is getting rid of this inconvenient fact about the monetary system, not for any real good, but just because we don't want the public to become aware of how the monetary system actually works.
Yeah, and I guess because now that's a cartel within a cartel. Because so if you were aware, just for example, that LIBOR, so you're talking about a bunch of bankers sharing information. Yeah, but who else was not privy to that information, which therefore gave you an inside edge, an inside track to be able to make bets, which nobody else really had. So in that sense, well, whether that's legal or not, I mean, it's insider trading. To my view, is a form of insider trading, but I guess not viewed that way.
No, and I would agree with you. And I think that's the downside of having a bank cartel be the monetary system. It's sort of like that's expected behavior. And again, we let it happen for a long period of time up until 2007 because everything worked. It's like, okay, do we care about bankers who have this information asymmetry advantage that they're using to their advantage? Well, because it benefits society, we'll let them do their thing. And then all of a sudden, when it doesn't benefit society, it starts to break down. Now we're going to pay attention to it. But now we're not going to really pay attention to it because it's a crime or it's a scandal. We're going to pay attention to it because it exposes the entire thing. It exposes what the monetary system really is. And there's such reprehensible behavior inside of it because of its inherent nature. Again, I'm not a proponent of the Eurodollar system. I don't like the idea of a bank cartel being this important to the global economy. And this is an offshoot of it. They're given a privileged position, which if you're given that privileged position, wouldn't you take advantage of it too? I mean, that's human nature. Whether it's ethical or not, that's a different story. But they did so, and they did so for a very long time. So, yeah, I agree with you, but I think the bigger scandal is how central bankers responded to it. Rather than exposing the way things work and giving people more information about how it works, they went in the opposite direction. Let's cover it up even further. Let's just hope that by covering up LIBOR, we can go back to the way things used to be. And I think that's the wrong direction too.
Yeah. So now we've had a couple of Fed insiders on our programs. You may know Daniela DiMartino Booth and a couple of others in the past. And what was interesting, because now I'm thinking the Fed and gold. Okay, so let's think about the Fed and gold for a minute. And in both instances, and in fact in three instances, they said, what you don't understand, Andy, is they just don't discuss gold. It is just not even on their radar. Okay, it took me a while to get my head around that because, and I think, but something changed. And I think this would be interesting to get your view on this. Something changed on the 1st of January. Is that gold became a Basel III NSFR Tier 1 asset that actually competes alongside, as it is of the same value as treasuries. So it's as an asset class. So what's so interesting, because I think all of a sudden it must have their attention, because obviously treasuries is part of their main focus, is it not? So if they have a competitor to that, and that the other interesting part about that is that in March 2022, when the Fed stepped in to intervene in the dollar against gold, and certainly did, because Russia said, well, we're going to make a grand price for gold, and there was this hoo-ha about it. But that story aside, what happened is during that sell-off between March and November of 2022, the Bank of International Settlements covered all 500 plus tons of their short bets, of their swaps, to zero. In the meantime, the Fed had dug this deeper and deeper hole by using paper gold to continue to sell gold. Whereas everyone else, every other central bank, every first-year liquidity provider I speak to, without exception, every first-year bank that we do deal with, without exception, is long gold. So the only people that are not long gold is the Fed, as far as I can determine, because certainly a lot of the action that we see intraday, you can see, and it's just that inverse dollar index or inverse bond to dollar trade. Obviously, that's an FX transaction. You're long one, you're short the other. But on the other side of that, there's a physical side to gold, which makes it quite different. And then, so what I'm saying is, on the 1st of January, Basel III NSFR conditions kicked in, and that I think they evolved from in March 2020, when we had that massive collapse, where we had the liquidity providers offering spot gold with no physical to back it up. And suddenly you've got this divergence where you've got almost $100 spread between the spot market and the futures market, because you've got all your shorts hedged in the futures market. And now someone's turning around to you in the spot market and saying, give it to me. Well, you don't have it. So everyone races to cover these short bets. And of course, the price is $100 difference per ounce. And it's cost a lot of money for a lot of people. So I think this is when we've got some good contacts on that in Switzerland. And I think that's pretty much when they brought NSFR standards in, or plan to bring NSFR standards in for liquidity providers. If you're going to provide gold, you sure as hell have to have that physical gold available to deliver. And if you can't offset it in the COMEX or other markets, then obviously you better be sure that you can offset that on the speculators that are siloed inside that market and cannot access the spot markets, the physically delivered spot markets. So it's interesting. And I think, so there's a dynamic shift. I guess what I'm saying is the dynamic shift here, where gold has suddenly become something that has to be noted. And Bank of International Settlements obviously knew what they were doing when they covered all their shorts. Just your thoughts on this.
Well, gold is, as you're saying, it's supposed to be, and it tends not to be at times, but it's supposed to be a non-fungible asset, right? I mean, it's a piece of physical commodity that you transact with, and that's a problem for Eurodollar banks, because they want to be able to funge everything. They want to be able to reborrow and repurpose or rehedge collateral. So gold is one of those that puts a constraint on the potential for liquidity providers to provide liquidity, as you're just demonstrating here. When gold participants were forced to pony up actual gold they didn't have, what happened? It caused enormous amounts of problems, which goes back to what we were just saying before, that the system itself resists challenges, because if it doesn't allow the banks to do what they want to do, they don't want to do it. They certainly don't want it to be imposed. They don't want systemic constraints imposed upon them. They certainly don't want convertibility, because that's giving people power that the banking system doesn't really want people to have. So there's this tug of war between, people trying to reform the system, introduce what they think are good ideas, and may actually be good ideas, some kind of constraint and some kind of lever of control. And you're always going to have the pushback from the Eurodollar banks themselves, who are going to say, no, just give us some time. We'll sort this out. We're going to go back to the way it was in, say, 2005. We'll see. It'll all work together. We'll maintain our privileged position. We don't need convertibility. No. Forget about all of that. And so I think that's what goes on in these periods, is that there's a tug of war between, let's put some external constraints on this and see where it goes. And the banking system says, no, we don't need that. We promise things will be better. And it leads to these dislocations in price, as well as trading and liquidity, which, as you were just describing, got to be pretty ridiculous and absurd. But it was just another way of exposing some of these fallacies that, we think of the banks that they have physical gold. They say they have physical gold, but as it turns out, they don't. They say they have collateral, but as it turns out, they don't really. They're just recirculating someone else's. And every time we keep exposing more of the internals of the system, they keep pushing back on it, and we never seem to go anywhere. Whether this gold move forces the banking system to become more transparent and opaque and more in line with the spirit of what the monetary system is supposed to look like in convertibility, we'll see. But I don't want to be that pessimistic. I'm just the system does not want to reform. Even in its bad state, it does not want to reform. And I think it's going to take a much bigger effort to reform. And I think the argument that we're making here is that maybe it ramps up slowly over time and incrementally, so that, instead of trying to reform everything at once, you start around the edges and work your way inward. And as long as you can make inroads and prove that this is a better way of doing things, then you can add the next thing, and then the next thing, and the next thing, realizing that the banking system is always going to push back against these things. They're always going to say, we don't want to transact in gold because it's too cumbersome. And you just have to continue to push it forward and keep moving it in the right direction, at least the direction you hope is the right direction.
It'd be interesting to see as we morph from a unipolar world into a multipolar world, how that affects the Eurodollar system, whether that is any kind of threat to it as it stands, or it, as you say, or it just evolves into what they. I mean, again, it's like a headless monster here, but essentially, it's a bunch of cartels, and somewhere in the middle is an aggregated direction. To me, it's what you're saying, and because we all deal with cartels every day, gold cartel, various cartels, and oil cartels. Some of them are public, some of them aren't. But yeah, so it'd be interesting to see how a multipolar world will affect or influence this Eurodollar system.
Yeah, and as you were saying, it's almost like a chameleon. If there was, a reasonable or realistic challenge to the Eurodollar framework, I think the banking system would morph itself to take advantage of it. Instead of, we wouldn't call it the Eurodollar anymore, and we don't need to call it the Eurodollar. It can be, there's a Eurodollar, there's a Euro, there's a Euro yen. It could be any. The banking system is simply a mechanism to create liquidity and to transact and do payment. It's basically a payment infrastructure with all sorts of financial utilities and payments utilities. It can theoretically move with the times. And so if we have a multipolar regional blocks of currencies, it's not unreasonable to expect that there's some form of the Eurodollar system that's at the center of all of it. Because in many ways, the Eurodollar isn't really the US dollar. We just call it the US dollar. We just call it US dollar denomination because, as I said from the very beginning, these are technically claims on US dollars, but they're not actual US dollars. So why couldn't it be technically claims on some other form of money? It wouldn't be out of the question to see the Eurodollar system evolve itself with the times, because that's what it did best, to take advantage of a multipolar world. Whether we want that or not, that's a completely separate question, because the bankers are going to go where the political power takes them, as well as the economic power. And the Eurodollar system at its root has the ability, the flexibility to change with the times, and I could see that happening. Again, the question is whether we want that to happen or not. I think we'd prefer to go in another direction, but that remains to be seen.
Again, what we've talked about here is obviously some form of trust system, whatever way you want to look at it, is a trust system of some sort, because all these cartels rely on each other's trust, and then that raises the question of, well, anybody that is ever siloed or behind a curtain has likely rehypothecated their assets to a great degree. And again, I guess that's the other issue here as we move to a multipolar world, perhaps when, you've got maybe a $2 quadrillion derivative market. And a lot of what we're talking about here are derivatives, trading against derivatives. And what if maybe somewhere along the line, there could be somebody pull a rug, and it must be a daisy chain. To be honest, if it does go, it goes down in flames, surely.
Well, that was 2008, really. 2008 was the crisis where we started. If you had to put 2008 crisis in just a couple words, and it's more complicated than that. But if it just had, what is the primary? It was a collateral shortage.
Yeah,
we started pulling out collateral from the system, and we couldn't meet because there wasn't enough. Essentially, we had mortgage bonds and mortgage structures and all sorts of securitized bonds that were treated as good as treasuries. And so as dealers started to look at the liquidity characteristics of some of these, they started to look at the credit characteristics. They said, well, we need to revalue them. We need to raise the haircuts. And the system was so leveraged and so it was transacted so many times, rehypothecated, it couldn't withstand that sort of revaluation. So that's really something that's already happened. But I will say one thing, that as we talk about the Eurodollar evolution moving forward and the monetary system moving forward, one of the major unappreciated factors that it took advantage of, not just calling itself the US dollar in denomination, but also the US legal structure, respect for private property, that type of thing, the ability to settle claims relatively straightforward and transparently. Obviously there's gray areas, but so a competing currency structure is going to have to be able to replicate that function as well. As much as we want to knock on the U.S. system and the U.S. government, and there's plenty of reason to do so, The U.S. court system, the arbitration system, the settlement mechanisms, that can't go unnoticed either. And I think that's one of the problems that we're finding with some of these competing blocks, the BRICS in particular. Do you really want to go into a Chinese court to settle an instrument? I don't think you do. So that's one of the legal structures that are involved too play a huge role, and it's an unappreciated role to how, first of all, the Eurodollar was able to take over, and one of the reasons why there hasn't really been a major competition to it, because that's a real central part of it. And going back to what you said, Andy, is absolutely true. It's trust. And part of that trust is, if you and I get into a contract dispute, how is it going to be resolved? Well, in the Eurodollar system, we know. We have judges, we have the court system. We know exactly how it's going to come out. I mean, yes, there's going to be a fight over the facts, but we know exactly how it's going to work. In a court system there is no BRICS court system, a Chinese court system, a Russian court system. That's not something you really want to get involved in. And so trust is it's not part of it. It's absolutely essential and crucial to the inner workings and the ability of a monetary system to expand and move into the realms that it needs to take on the roles of a reserve currency.
And I think you're very generous with your time. I'm going to need to ask you another question though. Now we're seeing debanking going on. I live in the UK. Nigel Farage, I don't know if you know of him, but he is. I've been on his show. He's a friend. I do know him. And now we've seen he drew attention to the fact just simply because he's on a major news channel and they cancelled his bank account. And he dug into it, freedom of information, what you call the freedom of information request, and found out that it's simply because he didn't agree with their systems, with their way of thinking. So it raised the question of, this is a social credit system then. So basically a bank account to me is a utility as important as water, electricity. Without a banking system, you cannot survive. And yet we found out through his work that over 1 million bank accounts have been debanked for social credit reasons. There's no other word for it. Also because people deal in cash. And I guess so we could look at, yes, okay, you say something the bank doesn't like, you get debanked. Okay, but I think the biggest focus is on cash. And so, and currently it's in fact, we've got government over here who's actually starting to push back against that and say, no, you really need, cash is a legal product, a legal tender, so should allow it. But quite clearly, there's a move to decash, to move cash out of the system because it provides freedom, it provides the ability to take responsibility and do things on your own. But I guess, does this lead into the central bank digital currencies, and is this really the road we're heading towards?
I would say it's actually the other. That's what's really leading to private digital currencies and blockchain technology. Mm-hmm. Because you're right. Central banks and governments want to be able to monitor, and just minor surveillance over the monetary system, and maybe look behind and see what you're doing, and maybe just try to nudge and influence your behavior a little. Maybe we'll actually impose some restrictions on the way you use cash. So yeah, there's always that snowball, let's push the envelope a little bit further with technology. And I think that's leading a lot of people to say, instead of a centralized digital currency, because I think we're moving toward that framework to begin with, why not a private blockchain technology that can accomplish everything else without the centralized control? Because you think about it, what are banks really? In a virtual credit environment or virtual money environment that we have already, they're nothing more than glorified bookkeepers, mm-hmm. which is what a blockchain is. And they're glorified bookkeepers that their entire existence and their entire privilege owes to the political power that allows them to operate as bookkeepers. And so if the government taps them on the shoulder, as you're saying, and says, you need to cancel those people because we don't like what they're saying, we trust the bookkeepers not to do that. But if they've already crossed that Rubicon where they're making political decisions or they're enforcing political decisions, I think that it doesn't just move more people toward private means of settlement like cash, but also private blockchains. Central bank digital currencies, there aren't really any serious central bank digital currency projects out there. Even the Chinese one has been an utter failure because most people don't trust them to begin with. But the bigger problem is they're not serious. In order to run a real, true digital currency, you need to invest in people and technology and infrastructure. It's not something you just slap together because you call it the Federal Reserve's Fed payment or Fed wire. Just slap the Fed name on it and it works. And central banks aren't really putting the time and effort and resources into creating useful digital currencies. So, the central bank digital currencies are a way for central bankers to say, oh, don't worry about that digital currency stuff. We're kind of doing that too. So you don't need to investigate Bitcoin or blockchain or anything else or Ethereum. We've got our own over here. It's another distraction to keep people focused on the status quo. But you're right. The more that this stuff comes up, the more people are going to look for alternatives because of course they are. Nobody wants an authority over your shoulder saying, I'm going to ostracize you and excommunicate you from the entire global marketplace by taking your bank account away. Then you won't be able to do anything. And I don't think people realize if you tried to live on just cash nowadays, it's actually impossible. How do you pay your bills? So there's a tremendous amount of power that as the more it gets abused, the more it actually leads people to alternatives.
So I guess really we're never going to see the Eurodollar on the trustless blockchain rails.
No, that's the thing. I think that's one thing the banking cartel is aware of, that blockchain is a existential threat to the banking system. Because once people realize that a blockchain, all it does is keep track of transactions. And once you realize that's what a blockchain is, you start thinking, do I really need my local bank to keep track of my transactions? We can transfer money on a blockchain. We don't need the bank. Why are we paying all these fees? Why are we giving them special privileges? And once enough people realize it's really the same kind of thing, it's not that big of a hurdle to start thinking, well, maybe we don't need the banking system at all.
Yeah, and of course it has its benefits because obviously us at Kinesis, we use a trustless blockchain system on Stellar blockchain, digitized physical gold. It belongs to the client. It can be redeemed. The important part, it can be redeemed at any time. Otherwise, what's the point? So I mean, there are multiple benefits to obviously having that technology, but its question is who employs it. So it's interesting.
Yeah, that's always the question, right?
But do you know what? Jeff, it has been such a pleasure to have you. I mean, I can't believe it. We've got about an hour here and it felt like 10 minutes. And perhaps we'll come back another time with us. I would recommend people listen to some of what you've said here at least twice. And I think it is a hard subject to understand. And thank you for tackling it. I don't know anyone else that has. And people should, obviously, they can come to your website, but they can also, we're obviously going to put some links up to get to you. But you have an education system and you have an academy, don't you not?
Yeah, sort of an academy. It's a university. I'll use quotes for it. If you want to find me, it's Eurodollar University. I do a YouTube show almost every day, 6 times a week. So there's always a YouTube show. It's at Eurodollar University. You have a website too, eurodollar.university, where I have memberships and subscriptions available where we get into these topics. Because you're right, Andy. It's not only important, it's really hard to understand and get your head around, especially since everything that we're taught from day one is Fed, government. And you don't really have much to go on, and except maybe your intuition that, we're missing something here. Something isn't quite right. Something isn't quite adding up. And it's a big intellectual leap to go from the Fed, don't fight the Fed, Alan Greenspan, the maestro, to wait a minute. All they do is move an interest rate around. They don't actually control the monetary system. It's a big intellectual leap to make. But once you get there, a lot of the world really starts to make much more sense.
I think you've stirred a lot of thoughts up here, and everyone who watches it is going to have more thoughts about this. This is something I'm really glad we did this today. And thank you so much for joining us. And I must say, look forward to hooking up again.
Yeah, it was my pleasure, Andy. Always happy to do it.
Thank you.
All right. Thank you, Andrew Maguire and Jeff Snider, for another fascinating discussion. And remember, buy physical and make sure it's backed 1-to-1, and understand the difference between what Andy affectionately calls the casino, paper, gold, and silver markets and the actual physical gold and silver markets. They're not the same, and don't be fooled. So there you have it. That's all we have for you today on another episode of Live from the Vault. Now keep spreading the word about this channel by hitting that like button, subscribe, and click on the bell if you'd like to be notified as each episode goes live. And with that, we'll see you right here next time on Live from the Vault. See you then.